Financial forecasting. Financial forecasting is the process of estimating or predicting how a business will perform in the future. This can include predicting future revenue, expenses, and capital needs. It is a crucial part of a company's strategic planning process, as it helps them to make informed decisions about how to allocate resources and pursue growth opportunities. Think of financial forecasting like guessing what you'll score on your final exams based on your current study habits. Businesses do the same but with money. They use what they know about their current financial situation to predict what might happen in the future. This helps them prepare and make better decisions. Percentage of sales forecasting. Percentage of sales forecasting is a popular financial forecasting method that makes use of historical sales data to predict future financial outcomes. Essentially, it's based on the assumption that most items on the income statement and the balance sheet will change proportionally with sales. This method is like predicting how much taller you'll grow next year based on your growth this year. Let's say you grew 2 inches last year. If you predict you'll grow the same amount next year, you'll end up 2 inches taller. For example, if sales were expected to increase by 10%, a firm using the percentage of sales method would typically forecast that its expenses and certain balance sheet items, like accounts receivable and inventory, would also increase by 10%. For instance, if a company's sales go up, they'll likely need to spend more money on making the products they sell. They use the percentage of sales method to guess how much more they'll need to spend. Importance of percentage of sales forecasting. This method is especially useful for firms with stable operations where costs and revenues grow at a consistent and predictable rate. It simplifies the forecasting process by allowing managers to apply a single growth rate to multiple accounts, rather than making separate forecasts for each one. Use in pro forma financials. Pro forma financial statements are projected financial statements. They show how actual financial statements might have looked if certain assumptions, like a projected growth rate, had been realized. By using the percentage of sales method, a company can create pro forma financial statements to forecast its income statement and balance sheet. This is just a fancy term for a business's financial report that shows what they expect their money situation to look like in the future. It's like a what-if scenario. For example, what if our sales go up by 10%? What will our expenses look like then? Estimating additional funding needs. Another vital use of the percentage of sales method is in estimating a company's additional funding needs. If a firm plans to grow its sales, it will likely need additional resources to support this growth, such as more inventory or larger receivables. By forecasting these changes, the firm can estimate its additional financing needs and plan accordingly. Additional funding. This is the extra money a business might need if they want to increase their sales. It's like needing more pocket money if you plan to buy more snacks at school. By forecasting, the business can figure out how much extra money they might need and where to get it from. Spontaneous account. These are accounts that change naturally with sales. Think of it as the amount of food you'd have to buy if you had more friends over. The more friends you invite, sales, the more food you'll need, spontaneous account. For a business, these could be things like the cost of materials to make their products. In conclusion, all these terms and techniques help a business understand their money situation better. Just like how you plan your studies for exams or budget your pocket money, businesses need to plan and budget their finances for future growth and success. The percentage of sales method is an efficient and practical tool for financial forecasting. It can help firms to project their financial statements, anticipate their funding needs, and make strategic decisions. Financial forecasting. This is like trying to predict the future of a business. It's a bit like weather forecasting, but for finances. You look at things like how much money a business is making, how much it's spending, and then try to guess what will happen in the future. It's important because, much like you wouldn't leave the house without checking the weather, businesses wouldn't want to make big decisions without first trying to predict financial outcomes. Percentage of sales forecasting. Imagine you have a lemonade stand, and last year you sold 100 cups of lemonade and spent $50 on lemons. If you want to sell 200 cups this year, you would expect to spend about $100 on lemons. That's the basic idea behind percentage of sales forecasting. If your sales grow, your costs and other things like inventory or money owed to you will likely grow at the same rate. It's a quick and easy way to guess what might happen in the future. Spontaneous accounts. These are accounts that change automatically when your sales change. Like in the lemonade stand example, the amount of money you spend on lemons would be a spontaneous account because it increases automatically when your sales increase. Sustainable growth rate using DuPont equation. The DuPont equation is like a financial health checkup. It's a formula that helps you understand how well a business is doing by looking at how much profit it's making, how efficiently it's using its assets, and how much financial risk it's taking on. The sustainable growth rate is the fastest rate a business can grow without borrowing more money. It's like asking, how big can my lemonade stand get before I need a loan for more lemons? Additional funds needed, AFN. Imagine you want to sell 300 cups of lemonade next year, but you only have enough money to buy lemons for 200 cups. The money you need to buy lemons for those extra 100 cups is the additional funds needed. It helps businesses plan for growth and know when they might need to borrow money or find new investors. Discretionary funds needed, DFN. This is money that a business needs but has some control over when and how they spend it. Suppose your lemonade stand is doing really well, and you decide you want to buy a fancy new sign to attract more customers. The money for that sign would be a discretionary fund. It's a cost that could potentially help your business grow, but it's not essential and you can decide when to spend it. All these concepts are important because they help businesses plan for the future, manage their money effectively, and understand how decisions they make today can impact their financial health down the line. It's like learning to manage your personal budget, but on a much larger scale. Sales growth rate formula. Sales growth rate equals forecasted sales / last year's sales. One explanation. Forecasted sales. This refers to the estimated or projected sales for the upcoming period. It's an educated guess based on various factors like market trends, economic conditions, historical sales data, and any other relevant information. Last year's sales. This is the total sales revenue generated in the previous year. It serves as a reference point to compare the current year's projected sales and see how much growth or decline is expected. Sales growth rate. This is the percentage by which the sales are expected to increase or decrease in the coming year. It is a crucial metric for financial forecasting as it helps businesses plan their operations, set targets, and allocate resources effectively. Why it's important. Financial forecasting. Forecasting sales growth is a fundamental step in financial forecasting. By predicting how much sales will increase or decrease, businesses can create accurate projections for their income statement and balance sheet. This, in turn, enables them to plan their expenses, investments, and profits. Resource allocation. Knowing the expected sales growth rate helps companies determine how much inventory to produce or purchase, how many employees to hire, and how much production capacity to utilize. It ensures that resources are allocated optimally to meet future demand. Investment decisions. For investors and stakeholders, the sales growth rate is a critical indicator of a company's performance and potential. Higher sales growth rates generally suggest a healthy and expanding business, making it an attractive option for potential investors. Identifying trends. Analyzing sales growth rates over multiple periods can reveal trends in consumer behavior, market conditions, and the effectiveness of business strategies. It allows businesses to adjust their approaches accordingly. Financial health. Steady and positive sales growth is vital for a company's financial health and long-term. Sustainability. Consistent growth ensures a stable revenue stream, making it easier for businesses to manage their operations and debt obligations. Competitive analysis. Comparing a company's sales growth rate with that of its competitors can provide insights into its market position and potential for gaining or losing market share. In summary, the sales growth rate is a crucial metric that helps businesses and investors understand the expected changes in sales revenue. It drives financial forecasting, resource planning, and investment decisions while providing valuable insights into a company's performance and position in the market. Sales growth rate formula. Sales growth rate equals forecasted sales / last year's sales. One example, 2017 sales were $50 million, and we are forecasting 2018 sales to be $60 million. What is the sales growth rate? Forecasted sales equals $60 million. 2017 sales equals $50 million. Sales growth rate equals 60/50 to 1 equals 0.20 equals 20%. Explanation. Forecasted sales. In this example, we are predicting that the sales for the year 2018 will be $60 million. This is the amount we anticipate the company will generate in sales for the upcoming year based on market analysis, business strategies, and other relevant factors. Last year's sales. This refers to the total sales revenue generated in the previous year, which is 2017 in this case. It serves as a benchmark for comparison, allowing us to see how much the sales are expected to grow or decline in the following year. Sales growth rate. This is the key metric we want to calculate. It tells us the percentage change in sales from the previous year to the forecasted year. In this example, the sales growth rate is 20%, which means the company is expected to experience a 20% increase in sales from 2017 to 2018. Why it's important. Financial planning. The sales growth rate is essential for financial planning and budgeting. It helps businesses estimate their future revenues and anticipate their financial performance for the upcoming year. This information is crucial for setting realistic targets and making informed business decisions. Business performance evaluation. Comparing the forecasted sales growth rate with the actual sales growth rate can provide insights into a company's performance. If the actual growth falls short of the forecast, it may indicate issues that need to be addressed, such as market challenges or operational inefficiencies. Investment decisions. Investors, shareholders, and stakeholders often look at the sales growth rate to assess a company's potential for growth and profitability. A higher sales growth rate may attract more investors and positively impact the company's stock value. Risk assessment. Understanding the sales growth rate helps businesses identify potential risks and challenges. For instance, if the growth rate is declining, it may indicate market saturation, increased competition, or shifts in consumer preferences, prompting the company to adapt its strategies accordingly. Resource allocation. A reliable sales growth forecast allows businesses to allocate resources efficiently. For instance, if a company expects a significant increase in sales, it may need to invest in expanding production capacity, hiring more employees, or increasing inventory levels. Competitive analysis. Comparing the sales growth rate of one company with its competitors provides insights into market dynamics and a company's relative performance. It helps identify areas where a business is excelling or lagging in comparison to its peers. In summary, the sales growth rate is a crucial metric that helps businesses and investors understand the expected changes in sales revenue. It plays a vital role in financial planning, decision-making, and performance evaluation, enabling companies to stay competitive and thrive in the market. Let's calculate the sales growth rate for the given problem and then expand on the key notes in simple terms, explaining why they are important. Given information. Forecasted sales for next year equals $125 million. Current year sales equals $85 million. Sales growth rate formula. Sales growth rate equals forecasted sales / current year sales. 1 calculation. Sales growth rate equals 125/85. 104706 explanation. Forecasted sales. In this problem, NSG, the company, is projecting or estimating that its sales for the next year will be $125 million. This forecast is based on various factors like market trends, historical data, growth strategies, and other relevant information. Current year sales. This is the sales revenue generated by NSG in the current year. It serves as the baseline for comparison and is essential to calculate the sales growth rate accurately. Sales growth rate. This is the key metric we want to find. It represents the percentage change in sales from the current year to the forecasted year. In this case, the sales growth rate is approximately 47.06%, indicating that NSG expects its sales to increase by around 47.06% in the next year. Why it's important. Financial planning and budgeting. The sales growth rate is a critical component of financial forecasting. It helps companies plan their budgets and set financial targets for the upcoming year. A higher sales growth rate may require more resources, while a lower rate may lead to cost-cutting measures. Business expansion and investment. A strong sales growth rate can attract investors and indicate that the company is on a growth trajectory. It provides confidence to investors that their investment may yield positive returns in the future. Performance evaluation. By comparing the projected sales growth rate with the actual growth rate, businesses can assess their performance. If the actual growth rate exceeds the forecast, it signals that the company is performing well and achieving its objectives. Operational decisions. Understanding the sales growth rate helps companies make operational decisions, such as inventory management, production capacity planning, and hiring strategies. Anticipating higher sales growth may necessitate scaling up production and workforce. Competitive analysis. The sales growth rate also aids in benchmarking against competitors. It allows companies to gauge how well they are faring compared to others in the same industry or market. Risk management. A declining or lower than expected sales growth rate may indicate potential risks, such as market saturation or competitive challenges. Identifying these risks early enables businesses to develop mitigation strategies. Stakeholder communication. The sales growth rate is a key metric communicated to stakeholders, including shareholders, investors, and board members. It provides them with insights into the company's future prospects and helps build trust and confidence in the management's decisions. In summary, the sales growth rate is a fundamental metric in financial forecasting that informs various aspects of a company's operations, strategic planning, and investor relations. It plays a crucial role in decision-making, performance evaluation, and assessing the company's overall health and potential for growth. Let's expand on the key notes and explain in simple terms what spontaneous accounts are and why they are important in financial forecasting. Spontaneous accounts. Spontaneous accounts are accounts on the income statement and balance sheet that automatically change in value as sales change. In other words, these accounts are directly linked to sales activity. When sales increase, these accounts also increase, and when sales decrease, they decrease accordingly. Spontaneous accounts play a crucial role in financial forecasting, as they help predict how various financial metrics will be impacted by changes in sales. Income statement accounts. Let's take a look at the spontaneous accounts on the income statement. Revenues. Revenues are the total sales generated by a company from its core business activities. As sales increase, revenues increase proportionally and vice versa. Cost of goods sold, COGS. COGS represents the direct costs associated with producing the goods or services sold by the company. As sales increase, more goods or services are sold, leading to higher COGS. Operating expenses. Operating expenses include various costs incurred to run the day-to-day operations of the business, such as salaries, rent, utilities, marketing, etc. These expenses often change with sales levels. For example, higher sales may require increased marketing expenses. Depreciation. Depreciation is a non-cash expense that represents the allocation of the cost of tangible assets over their useful lives. While not directly affected by sales, it's an essential part of the income statement. Taxes. Taxes represent the amount of income tax a company owes based on its profits. Taxes may vary based on changes in revenues and expenses. Balance sheet accounts. Now, let's look at the spontaneous accounts on the balance sheet. Accounts receivables. Accounts receivables are amounts owed to the company by its customers for goods or services sold on credit. As sales increase, more customers owe money to the company, leading to higher accounts receivables. Inventory. Inventory represents the goods or raw materials a company holds for production or resale. When sales increase, more inventory may be required to meet the higher demand. Accounts payables. Accounts payables are amounts owed by the company to its suppliers for goods or services received on credit. As sales increase, the company may need to purchase more goods, leading to higher accounts payables. Accruals. Accruals are expenses that have been incurred but not yet paid. For example, if the company hires more people to handle increased sales, the corresponding payroll expense will lead to higher accruals. Why they are important. Forecasting accuracy. Spontaneous accounts are directly related to sales, making them essential for accurate financial forecasting. Predicting changes in these accounts based on forecasted sales helps create a more comprehensive and reliable financial outlook. Resource planning. Understanding how spontaneous accounts change with sales allows companies to plan their resources accordingly. For example, if sales are expected to increase, the company can plan for higher inventory levels, additional staffing, or extended credit terms for customers. Working capital management. Spontaneous accounts like accounts receivables, accounts payables, and inventory significantly impact a company's working capital. Proper management of these accounts ensures that the company maintains adequate liquidity to support its operations. Profitability analysis. Monitoring the relationship between sales and spontaneous accounts helps in analyzing the profitability of different products, services, or business segments. It allows companies to identify areas where they are most profitable and areas that may need improvement. Investor confidence. Investors and stakeholders often analyze spontaneous accounts to assess a company's operational efficiency and financial health. Stable and well-managed spontaneous accounts can enhance investor confidence and contribute to a positive company image. In summary, understanding spontaneous accounts and their relationship with sales is crucial for financial forecasting, resource planning, working capital management, and overall performance evaluation of a company. These accounts provide valuable insights into a company's financial health and play a significant role in strategic decision-making. Let's expand on the key notes about the sustainable growth rate, SGR, and explain in simple terms why they are important. Sustainable growth rate, SGR. The sustainable growth rate, SGR, is the maximum rate at which a company can grow without having to rely on additional debt or equity financing to support that growth. In other words, it represents the growth rate that a company can sustain using its existing resources and profitability without taking on more debt or issuing more shares of stock. Explanation in simple terms. Imagine you have a small business that is currently growing at a certain rate, let's say 10% per year. The sustainable growth rate is the maximum rate at which your business can grow while still managing to finance that growth using only its profits and existing resources. It means that your business doesn't need to borrow money from banks or ask for more investment from shareholders to fund its expansion. Why it's important. Financial stability. Understanding the sustainable growth rate is crucial for a company's financial stability. It helps a company avoid excessive reliance on external financing, which can lead to increased debt and interest payments or dilution of ownership through issuing more shares. Long-term viability. By identifying the maximum rate of growth that can be sustained internally, a company can plan for long-term viability. It helps set realistic growth targets that the company can achieve without putting itself at risk. Capital structure management. Maintaining a balanced capital structure, mix of debt and equity, is vital for financial health. Knowing the SGR allows a company to make informed decisions about how much debt or equity financing it can afford to take on without jeopardizing its stability. Investor confidence. Sustainable growth is an attractive quality for investors. Company can demonstrate that it can grow steadily without needing constant injections of capital. It can instill confidence in shareholders and potential investors. Operational efficiency. Achieving a sustainable growth rate often requires efficient use of resources and maximizing profitability. Companies that can grow without increasing their expenses at the same rate can enhance their overall efficiency and profitability. Strategic planning. Knowing the SGR helps management in strategic planning. It enables them to set growth targets that are feasible and align with the company's capabilities and financial resources. Risk management. Excessive growth without proper financing can strain a company's resources and increase financial risk. Understanding the SGR helps mitigate the risk of overextending the company's operations. In summary, the sustainable growth rate is a critical metric that indicates the maximum rate at which a company can grow using its internal resources and profitability, without relying on additional external financing. It promotes financial stability, efficient resource utilization, and long-term viability, which are essential for sustainable success and investor confidence. By staying within its sustainable growth rate, a company can maintain a healthy financial position and support its expansion in a responsible and controlled manner. Using return on equity, ROE, for SGR calculation. 1. Basic equation of net income/total equity, SGR equals net income slash total equity 2. DuPont equation of ROE. SGR equals net income margin x asset turnover x leverage multiplier. Explanation in simple terms. Return on equity. ROE is a financial ratio that measures how efficiently a company generates profits from the money invested by its shareholders, equity. It indicates the percentage return on each dollar of equity invested in the business. 1. Basic equation. If we use the basic equation for ROE, it's like asking, how much profit, net income, is the company generating for each dollar of shareholders' equity? The SGR, calculated using this basic ROE equation, represents the growth rate a company can achieve while retaining its earnings to support future growth. 2. DuPont equation. The DuPont equation breaks down ROE into 3 components. Net income margin. This measures the company's ability to generate profit from its sales. A higher net income margin means the company is keeping more profit from each dollar of revenue. Asset turnover. This indicates how efficiently the company utilizes its assets to generate sales. Higher asset turnover means the company is generating more sales with fewer assets. Leverage multiplier. This represents the level of financial leverage or debt used by the company to finance its assets. A higher leverage multiplier means the company relies more on debt financing. By using the DuPont equation, we can analyze which of these components contribute the most to ROE. If a company can improve its net income margin, asset turnover, or leverage multiplier, it can potentially increase its ROE and thus its SGR. Why it's important. Sustainable growth planning. Calculating the SGR using ROE helps companies set realistic growth targets based on their profitability and equity structure. It guides them in planning for growth that can be sustained without needing excessive external financing. Performance evaluation. ROE is a crucial metric for evaluating a company's financial performance. A consistently high ROE suggests efficient use of equity capital and strong profitability. Strategic decision-making. The components of ROE in the DuPont equation provide insights into areas where a company can improve its financial performance. Companies can focus on enhancing profit margins, optimizing asset utilization, or managing their debt levels more effectively. Investor confidence. A high and consistent ROE, along with a reasonable SGR, can attract investors' confidence and demonstrate that the company is generating value for its shareholders. Risk management. Understanding the relationship between ROE and SGR helps in managing financial risk. Companies can avoid aggressive growth plans that might strain their financial position and lead to increased risk. Competitive analysis. Comparing a company's ROE and SGR with its competitors allows for benchmarking and understanding relative performance in the industry. In summary, using return on equity, ROE, to calculate the sustainable growth rate, SGR, provides valuable insights into a company's financial health, performance, and capacity for sustainable growth. It helps companies set growth targets, make informed strategic decisions, and attract investor confidence by demonstrating efficient use of capital and profitability. Let's expand on the key notes about the sustainable growth rate, SGR, formula and explain in simple terms why they are important. SGR formula. SGR equals ROEX, 1 bit. Explanation in simple terms. The sustainable growth rate, SGR, formula combines 2 important financial ratios, return on equity, ROE, and the payout ratio, B. To calculate the maximum growth rate, a company can sustain using its own retained earnings without having to raise additional equity or debt financing. 1. Return on equity, ROE. Return on equity, ROE, is a financial ratio that measures how efficiently a company generates profits from the money invested by its shareholders' equity. It indicates the percentage return on each dollar of equity invested in the business. A higher ROE generally implies that the company is effectively utilizing its shareholders' investments to generate profit. 2. Payout ratio, B. The payout ratio, B, is the proportion of net income that a company distributes to its shareholders in the form of dividends. It is calculated by dividing the total dividends paid by the net income. The payout ratio represents how much of the company's earnings are being given back to shareholders as dividends rather than being reinvested back into the business. SGR interpretation. The SGR formula tells us that the sustainable growth rate of a company depends on two factors. ROE. The higher the ROE, the more profit the company generates from its equity, allowing for higher sustainable growth. Payout ratio, B. The higher the payout ratio, the more earnings are being distributed to shareholders, leaving less money to be reinvested in the business for growth. The SGR represents the growth rate that a company can achieve using its retained earnings, profits not paid out as dividends, to finance growth internally without resorting to external financing like issuing new shares or taking on more debt. Why it's important. Financial planning. Calculating the SGR helps companies set growth targets based on their profitability and dividend policies. It guides them in planning for growth that can be sustained without diluting shareholders' ownership or increasing debt. Capital structure management. The SGR allows companies to balance their financial structure by determining the optimal level of reinvestment versus dividend distribution. A company can maintain a healthy balance between internal financing and external financing. Investor perspective. Investors use the SGR to evaluate a company's growth potential and dividend policy. A sustainable and reasonable growth rate signals a stable and healthy business that can generate returns for investors over the long term. Dividend policy. Companies must strike a balance between reinvesting profits for growth and distributing dividends to shareholders. The SGR helps management make informed decisions about the appropriate level of dividend payments. Risk management. Understanding the relationship between ROE, payout ratio, and SGR helps in managing financial risk. Companies can avoid overly aggressive growth plans that might strain their financial position and reduce dividend stability. In summary, the Sustainable Growth Rate, SGR, formula is a valuable tool for companies and investors alike. It enables companies to plan for sustainable growth while considering their profitability and dividend policies. By understanding the SGR, companies can strike a balance between retaining earnings for growth and rewarding shareholders through dividends, which is essential for long-term success and investor confidence. Let's rewrite the Sustainable Growth Rate, SGR, formula to make it more understandable, and then expand on the key notes in simple terms to understand their importance. SGR formula. SGR equals net income / sales x sales / assets x assets / equity x. 1. Dividends / net income explanation in simple terms. The revised SGR formula breaks down the growth rate into 4 components, each representing a crucial aspect of a company's financial performance. Net income margin. This represents the percentage of profit a company makes for each dollar of sales revenue. A higher net income margin indicates that the company is efficiently managing its costs and generating more profit from its sales. Asset turnover. This ratio shows how efficiently a company uses its assets to generate sales revenue. A higher asset turnover means the company is effectively using its resources to generate more sales. Leverage multiplier. This component indicates the level of financial leverage or debt used by the company to finance its assets. A higher leverage multiplier means the company relies more on debt financing. Dividend retention rate. This component represents the portion of net income that the company retains for reinvestment in the business rather than distributing it to shareholders as recasting. It helps companies set growth targets and determine whether they have the capacity to finance that growth internally. Investor confidence. A company with a reasonable and sustainable growth rate, supported by efficient resource utilization and prudent financial management, can instill confidence in investors. In summary, the revised SGR formula breaks down the growth rate into key components, providing a more detailed understanding of a company's financial performance and capacity for sustainable growth. Each component plays a critical role in evaluating the company's health, efficiency, and ability to reinvest in itself. By comprehending and optimizing these components, companies can enhance their growth potential and attract investor confidence. Calculate the Sustainable Growth Rate, SGR, for NGS Corp using the provided information, and then expand on the key notes in simple terms to understand their importance, given information. Net income equals $2.66 million, dividends equals $1.0 million, sales equals $66.0 million, total assets equals $165.9 million, total equity equals $95 million SGR formula. SGR equals net income slash sales x sales slash assets x assets slash equity x. 1. Dividends slash net income. Calculation. Net income margin equals net income slash sales equals $2.66 million slash $66.0 million. 0403 asset turnover equals sales slash total assets equals $66.0 million slash $165.9 million. 03977 leverage multiplier equals total assets slash total equity equals $165.9 million slash $95 million. 174.63 dividend retention rate equals 1. Dividends slash net income equals 1. $1.0 million slash $2.66 million. 06241 SGR equals 0403x 03977 174.63x 6241.0579 or 5.79% explanation in simple terms. The SGR formula breaks down the sustainable growth rate of a company into 4 components, each representing an important aspect of its financial performance. Net income margin. This ratio tells us how much profit the company makes for each dollar of sales. In this case, for every dollar of sales, NGS Corp makes approximately $0.403 of profit. Asset turnover. This ratio shows how efficiently the company uses its assets to generate sales revenue. NGS Corp generates about $0.3977 of sales for each dollar of assets it has. Leverage multiplier. The leverage multiplier indicates how much debt the company has compared to its equity. NGS Corp has approximately $1.007,463 of assets for every dollar of equity. Dividend retention rate. This component shows how much of the company's net income is retained for reinvestment rather than paid out as dividends. NGS Corp retains about 62.41% of its net income for growth and reinvestment. Why it's important. Sustainable growth planning. The SGR helps companies set realistic growth targets based on their profitability, asset utilization, financial leverage, and dividend policies. It guides them in planning for growth that can be sustained without excessive reliance on external financing. Resource utilization. Understanding the asset turnover ratio is important for assessing how efficiently a company is using its assets to generate sales. Higher asset turnover indicates better resource utilization. Financial health. The leverage multiplier indicates the level of financial leverage and helps assess a company's financial health. Too much debt can increase financial risk, while a healthy balance between debt and equity is essential for long-term stability. Dividend policy. The dividend retention rate reflects the company's approach to dividends. A higher retention rate means the company is reinvesting more in itself for growth and expansion. Investor confidence. A company with a reasonable and sustainable growth rate, supported by efficient resource utilization and prudent financial management, can attract investor confidence and potential investment. Strategic decision-making. The SGR components provide insights into areas where a company can improve its financial performance. For example, focusing on increasing net income margin or asset turnover can contribute to higher sustainable growth. In summary, the sustainable growth rate, SGR, is a valuable metric that helps companies and investors assess a company's financial performance, growth potential, and dividend policy. By understanding and optimizing the components of the SGR formula, companies can plan for sustainable growth and enhance their overall financial health and attractiveness to investors. Let's expand on the key notes about strategies to reduce discretionary financing needed, DFN, and explain in simple terms why they are important. Discretionary financing needed, DFN. DFN is the amount of external financing a company needs to support its projected growth rate. It represents the additional funds the company must acquire through debt or equity financing to support its expansion beyond what can be generated from internal sources like retained earnings. Strategies to reduce DFN. Reduce sales growth. By increasing prices, a company can achieve 2 benefits. A. Increased net income margin. Higher prices lead to higher profit margins, as the company is making more profit on each sale. B. Decreased need for assets and lower DFN. With higher prices, the company might experience reduced demand for its products, resulting in lower sales growth. Lower sales growth means less need for additional assets to meet higher demand, resulting in a reduced DFN. Obvious negative. The obvious negative to increasing prices is that it may lead to a decrease in customer demand. Customers may be unwilling or unable to pay higher prices, which could lead to a loss of market share or reduced sales. Review capacity constraints. Instead of immediately buying new fixed assets to increase capacity, a company should assess whether there are alternative ways to increase production without significant capital investment. This could include optimizing existing assets, improving production processes, or outsourcing certain operations. Importance. Reviewing capacity constraints helps the company avoid unnecessary capital expenditures and ensures efficient use of existing resources. It can also reduce the need for external financing to fund new asset purchases. Lower dividend payout. If the company retains more of its net income and pays out lower dividends to shareholders, it will have more cash available for reinvestment in the business. This increased retained earnings can be used to purchase new assets without relying on external financing. Importance. Lowering dividend payouts allows the company to build up internal funds for growth and expansion. It provides a stable source of funding for capital projects and reduces reliance on external sources of financing. Increased net income margin. By focusing on improving operational efficiency, cost management, and pricing strategies, the company can increase its net income margin. A higher net income margin means the company is generating more profit for each dollar of sales. Importance. Increasing net income margin directly impacts the company's ability to generate internal funds for growth. Higher profitability provides more cash that can be reinvested in the business and reduces the need for external financing. Why these strategies are important. Financial stability. By implementing these strategies, the company can reduce its reliance on external financing, which enhances its financial stability and reduces financial risk. Sustainable growth. Managing DFN allows the company to achieve sustainable growth without overburdening its balance sheet with excessive debt or diluting shareholders' ownership through equity issuance. Investor confidence. Investors value companies that can finance their growth internally without constantly requiring additional external financing. It indicates strong financial management and efficiency. Flexibility. A company with lower DFN has more flexibility in making strategic decisions and capital investments, allowing it to seize growth opportunities as they arise. Cost effectiveness. By optimizing existing resources and focusing on efficiency, the company can minimize unnecessary expenses and make the best use of its capital. In summary, the strategies to reduce DFN are essential for maintaining financial health, promoting sustainable growth, and ensuring efficient use of resources. These strategies allow the company to strike a balance between internal financing and external financing, enabling it to grow while remaining financially stable and attractive to investors. Forecasting is basically making educated guesses about future events based on different types of data and methods. There are a few types of data we use in forecasting. Time series data. This is data collected over time at regular intervals, like daily stock market closing values. It helps us find trends and make predictions based on them. Cross-sectional data. This is data collected from many subjects at the same time, like measuring the height and weight of a group of people to figure out obesity rates. It gives us a snapshot of a population at a certain point in time. Longitudinal data. This is data collected from the same subjects over a long time, like tracking a group of people's health for many years. It helps us see changes and trends in these subjects over time. We also use judgmental methods in forecasting, which involves using intuition, opinions, and estimates to make predictions. For example, experts can use their knowledge to predict future technology trends. Now, in fields like finance and accounting, forecasting is used to estimate future financial outcomes for a company. It's like a financial fortune-telling. For example, economists can use past sales data and current market trends to guess a company's future revenue. One of the hardest parts of financial forecasting is predicting a company's future sales. Predicting future costs is a bit easier, since we can use past accounting data, and it's often related to sales. A financial forecast is not the same as a financial plan or budget. It's more like a prediction of what might happen, rather than a plan of what should happen. People outside a company can also use financial forecasts to guess how successful the company will be in the coming year. That's the gist of it. Forecasting is all about predicting the future based on the past and present, using different types of data and methods. Forecasting is like trying to predict the future. It's when we make statements about things that haven't happened yet. We use different methods and data to make educated guesses about what might happen in the future. For example, we might try to predict how much money a company will make next year or how many people will buy a certain product. Time series data in simple terms. Time series data is like a sequence of measurements taken at different times. We measure something repeatedly, like every day or every year, and then look for patterns or trends in the data. For example, we might track the stock market's daily closing value over time or the amount of water flowing in a river each year. Cross-sectional data. Cross-sectional data is like taking a snapshot of a group of things at the same time. We collect information about many subjects, like people or companies, at one specific point in time, without worrying about how they change over time. For example, we might randomly survey people to find out how many of them are considered obese at that particular moment. Longitudinal data. Longitudinal data is like following the same group of things over a really long time. We observe the same subjects repeatedly over many years, even decades. It helps us see how things change over time and understand trends that happen over the long run. For example, we might study the same group of people over their entire lives to see how their behavior or health changes as they grow older. Judgmental methods in simple terms. Judgmental methods are when we use our own opinions, experience, and feelings to make forecasts. We don't rely solely on data and formulas. Instead, we trust our instincts and make educated guesses based on our knowledge. For example, we might use expert opinions or conduct surveys to predict future trends or outcomes. Importance of forecasting. Forecasting is important because it helps us plan for the future. Whether it's for a company, a government, or even predicting weather conditions, forecasting helps us make decisions and be prepared for what might happen. It's like looking into a crystal ball to see what's coming, even though we can't be 100% sure. By using different methods and data, we try our best to make accurate predictions and avoid surprises. Forecasting in simple terms. Forecasting is like trying to predict the future. It's making educated guesses about things that haven't happened yet. We use different methods and data to estimate what might happen in the future, like how much money a company will make or how many people will buy a product. Mental model. Think of forecasting as looking into a crystal ball to see what might happen tomorrow, next week, or next year. 2. Time series, cross-sectional, and longitudinal data in simple terms. Time series data. It's like tracking something over time and seeing patterns, like measuring stock prices each day or the annual flow of a river. Cross-sectional data. It's like taking the snapshot of many things at the same time, without worrying about changes over time. For example, measuring obesity levels in a group of people at one specific moment. Longitudinal data. It's like following the same group of things for a long time, observing how they change over decades. Think of studying people's behavior or health throughout their entire lives. Mental model. Imagine time series as a movie showing changes over time, cross-sectional as a photo of a group at one moment, and longitudinal as a documentary tracking individuals over a lifetime. 3. Example exercise. Question. What type of data is it when we observe and measure the annual income of different families living in a city at the same point in time? Answer. Cross-sectional data. It's like taking a snapshot of different families' income at one specific time. 4. Advantages and disadvantages of forecasting and importance to know. Advantages. Helps plan for the future and make informed decisions. Assists in financial analysis and investment decisions. Allows companies to set growth targets and allocate resources effectively. Helps predict market trends and customer behavior. Disadvantages. Forecasts may not always be accurate, as the future is uncertain. It relies on historical data, which might not always reflect future changes. External factors like unexpected events or economic conditions can disrupt forecasts. Importance of knowing. Forecasting is vital for businesses to make wise financial decisions and be prepared for the future. It helps analysts and investors estimate a company's potential success. Understanding different data types, time series, cross-sectional, longitudinal, helps in choosing appropriate methods for analysis. Forecasting aids in managing risks and identifying growth opportunities. Mental model. Think of forecasting as a map for businesses to navigate the future. While it might not always be perfectly accurate due to changing roads and detours, having a map is better than driving blindly into the unknown. In summary, forecasting is like making educated guesses about the future. We use different types of data and methods to estimate what might happen. Time series tracks changes over time. Cross-sectional is like a snapshot of a group at one moment, and longitudinal follows the same group over a long time. Forecasting is important for businesses and investors to plan and make decisions wisely, even though it may not always be 100% accurate due to the uncertainties of the future. 12 key points to understand the topic of forecasting. Forecasting definition. Forecasting is like predicting the future. It's about making statements about events that haven't happened yet. Types of data used. There are three main types of data used for forecasting. Time series. It's like tracking data over time, like measuring stock prices daily. Cross-sectional. It's like taking a snapshot of many subjects at the same time, without caring about changes over time. Longitudinal. It's like studying the same variables in a group repeatedly over many years. Judgmental methods. This involves using our instincts, opinions, and best guesses to make forecasts, like taking expert opinions or conducting surveys. Key terms. Remember important terms like probability sample, studying a subset with known likelihood, and non-probability sample, subset without known likelihood. Forecasting and accounting. In finance and accounting, forecasting helps estimate a company's future financial outcomes based on historical data and market indicators. Financial forecast. It's an economist's best guess of a company's financial situation over a specific time, usually 1 year. Challenges. Predicting revenue is one of the hardest parts of financial forecasting, and future costs can be estimated based on historical accounting data. Forecasting versus plans and budgets. A financial forecast doesn't have to be a planning document, and outsiders can use it to predict a company's success. Time series data. It's like a sequence of measurements taken at uniform time intervals, and it helps predict future values based on past data. Cross-sectional data. It's like observing and comparing many subjects at one point in time to understand differences among them. Longitudinal data. It's like studying the same group of subjects over a long time to track changes accurately. Importance of forecasting. Forecasting is crucial for making informed decisions, setting growth targets, and planning for the future. Mental model. Think of forecasting as a crystal ball trying to predict future events using different data and methods. Imagine time series as a movie, cross-sectional as a photo, and longitudinal as a documentary. Judgmental methods are like taking expert advice to make educated guesses. And the key terms are like vocabulary you should remember to understand forecasting better. Example exercise. Question. What type of data is it when we track and measure the same group of people's weight and height every year for 10 years? Answer. Longitudinal data. It's like observing the same group over a long period to understand how their weight and height change over time. Understanding forecasting is essential in various fields, from finance to marketing, as it helps us plan and make better decisions for the future. Spontaneous assets are items on a company's balance sheet that automatically grow as the business sells more products or services. They are things like accounts receivable, money owed to the company by customers, and inventory, goods ready to be sold. Spontaneous assets are crucial for a company's day-to-day operations and are listed as current assets on the balance sheet. On the other hand, fixed assets like buildings or equipment do not change with sales and are not considered spontaneous assets. The growth in spontaneous assets is significant for companies when they decide if they need to borrow money. If the company's incoming cash from sales is enough to cover its costs, it can avoid borrowing money, which lowers its financing expenses. Just like spontaneous assets, there are also spontaneous liabilities. These are the company's obligations that increase with sales. For example, an increase in cost of goods sold, COGS, is tied to an increase in spontaneous liabilities. Working capital, which is the difference between current assets and liabilities, is essential for a company to fund its daily operations. If current assets, like cash, accounts receivable, and inventory, are not enough to cover current liabilities, the company may face financial difficulties in meeting its spontaneous liabilities. In summary, spontaneous assets are essential for a company's day-to-day business, and they grow as the company sells more. If the company manages its spontaneous assets well, it can better handle its liabilities and keep its operations running smoothly. For example, when a company receives orders for products, it manufactures more goods, inventory, to sell, and as it makes sales, it receives accounts receivable and cash deposits. These are considered spontaneous assets that naturally grow as the business expands. Spontaneous assets are like the automatic helpers a company gets when it sells more stuff. When a company sells products or services, some things naturally grow along with it, like money owed by customers, accounts receivable, and goods to be sold, inventory. These automatic helpers are essential for the company's everyday operations and are shown on the balance sheet. However, things like buildings or equipment, which don't change with sales, are not part of spontaneous assets. 2. Mental model/analogy. Imagine a company as a garden that sells flowers. When the company sells more flowers, its garden automatically grows some extra flowers and keeps them ready to sell, inventory. Customers who buy flowers promise to pay later, so the company keeps track of the money they owe, accounts receivable. These automatic helpers grow along with the company's sales. 3. Example exercise. Question. If a company sells 100 widgets in a month and each widget costs $10, how much will be the accounts receivable if customers are allowed to pay later? Answer. The accounts receivable will be $1,000. 100 widgets x $10 each. 4. Advantages and disadvantages. Advantages. Spontaneous assets are like natural support for a company's growth. As sales increase, these assets grow automatically, helping the company handle more business without extra effort. This makes it easier for the company to manage its daily operations. Disadvantages. While spontaneous assets are helpful, they also come with responsibilities. For example, if the company doesn't keep a good balance between its current assets and liabilities, it may struggle to meet its obligations and face financial challenges. Importance of knowing spontaneous assets. Understanding spontaneous assets is crucial for businesses to plan for growth and make informed financial decisions. By knowing how these assets change with sales, companies can manage their resources effectively and ensure smooth operations without running into financial difficulties. 12 key points about spontaneous assets. What are spontaneous assets? Spontaneous assets are things a company automatically gets when it sells more products or services. Types of spontaneous assets. Common spontaneous assets include money owed by customers, accounts receivable, and goods ready to be sold, inventory. Not all assets are spontaneous. Spontaneous assets are connected to sales, but fixed things like buildings or equipment aren't part of them. How they grow. As a company sells more, spontaneous assets naturally increase, helping with everyday business. Cost of goods sold, COGS, and revenues. When spontaneous assets grow, it's often because the cost of making goods decreases or sales increase. Working capital matters. Working capital is the difference between current assets, like cash and inventory, and current liabilities, debts due soon. It's vital for a company's operations. Evaluating borrowing needs. Companies look at projected spontaneous asset growth to see if they need to borrow money to cover costs. Spontaneous liabilities. Just like spontaneous assets, some liabilities also change with sales. These are called spontaneous liabilities. Importance of balance sheet. Spontaneous assets and liabilities are both important for companies to manage as they are recorded on the balance sheet. Financial challenges. If a company's current assets don't consistently exceed its current liabilities, it may face financial difficulties. Short-term obligations. Current liabilities include things like money owed to vendors or service providers that need to be paid soon. Example of spontaneous assets. If a company sells more widgets, it will naturally have more widgets to sell, inventory, and money owed by customers, accounts receivable. Understanding spontaneous assets helps businesses plan for growth, manage their finances, and ensure they can meet their obligations without facing financial troubles. Spontaneous liabilities are like bills that a company automatically accumulates while doing its regular business. These liabilities increase when the company sells more products or provides more services, leading to higher costs. The key spontaneous liabilities usually include things like accounts payable. These are short-term debts the company owes to its suppliers or creditors for things like raw materials. The company gets some time to pay these bills, like 30, 60, or 90 days in the future. Wages payable. When there's more work to do because of increased sales, the company may have to pay workers more, like for overtime or extra shifts. Taxes payable. If the company makes more profit from higher sales, it may owe more taxes to the government. These liabilities are called spontaneous because they come up automatically due to changes in sales. They are not directly controlled by the company itself, but depend on how much the company sells. For example, let's take Tesla as an example. When Tesla's car sales went up by 64% in 2019 compared to the previous year, its revenue, money earned from selling cars, increased by a lot. But the cost of making those cars, like buying materials and paying workers, increased even more by 68%. This increase in costs is a spontaneous liability because it's directly linked to the increase in car sales. On the other hand, some costs like overhead expenses, like office rent, salaries of top management, etc., may not increase or decrease with sales, so they are not spontaneous liabilities. Why are spontaneous liabilities important? Well, companies need to manage their finances properly to make sure they can handle these. Spontaneous bills. They need to have enough short-term assets like cash and money owed by customers, accounts receivables, to cover these liabilities. If they can't cover these bills comfortably, it can lead to financial problems for the company. For investors, it's important to keep an eye on how much it costs the company to generate sales, because even if sales go up, if the costs increase even more, it may affect the company's overall financial health. So, in a nutshell, spontaneous liabilities are like automatic bills that increase when a company sells more, and it's crucial for companies and investors to keep track of them to stay financially healthy. Spontaneous liabilities are like automatic bills that pile up for a company as it does its regular business. When the company sells more products or services, these bills increase because the costs of producing those goods or providing the services go up. These costs include things like paying suppliers, workers, and taxes. It's essential for companies and investors to keep track of these bills to stay financially healthy. 2. Mental model. The magic cafe. Imagine a magical cafe that serves delicious cakes. When the cafe sells more cakes, it automatically receives bills for the ingredients used to make the cakes and for the wages of the bakers. These bills pop up on their own, just like magic, whenever the cafe sells more cakes. The more cakes they sell, the more bills they get. So, the cafe needs to manage its money wisely to handle these magical bills and stay in business. 3. Example exercises. True or false? Spontaneous liabilities are the obligations of a company that come up automatically as a result of its regular business. True, what are some examples of spontaneous liabilities that may increase when a company's sales go up? Examples of spontaneous liabilities include accounts payables, bills to suppliers, wages payable for workers, and taxes payable. Advantages and disadvantages and importance. Advantages of spontaneous liabilities. They reflect the company's normal business operations. They can be managed with careful financial planning. Disadvantages of spontaneous liabilities. If not managed well, they can lead to financial challenges for the company. Rapid increases in spontaneous liabilities can be difficult to handle. Why is this important to know? Understanding spontaneous liabilities is crucial for companies to plan their finances effectively. If the company cannot handle these automatic bills comfortably, it may face financial difficulties. For investors, monitoring the costs associated with sales is vital because it can impact the company's overall financial health, even if sales are increasing. By grasping the concept of spontaneous liabilities and how they relate to a company's sales, you can better understand the company's financial health and make informed decisions as an investor or business owner. Spontaneous liabilities are the automatic obligations that a company accumulates due to its day-to-day business activities. Tied to cost of goods sold, COGS. An increase in spontaneous liabilities is usually connected to an increase in a company's cost of goods sold or cost of sales. COGS includes the costs involved in production, like raw materials and labor. Not fixed costs, such as building expenses, do not change with sales volumes and are not considered spontaneous liabilities. Examples of spontaneous liabilities. These often include accounts payables, short-term debts owed to suppliers and creditors, wages payable for workers tied to production, and taxes payable, which can increase with higher profits. Spontaneous nature. They are called spontaneous because they arise from changes in sales activity and are not directly controlled by the company itself. Dependent on sales and production volumes. Spontaneous liabilities are influenced by the company's sales or production levels. Accounts payable example. If a company buys raw materials to make products, they get a bill, accounts payable, from the supplier, and they typically have time, 30, 60, or 90 days, to pay it. Wages payable example. When sales increase, more workers may be needed, leading to overtime or extra shifts, which results in higher wages payable. Taxes payable example. Higher sales may lead to more profit, resulting in a larger tax liability to the government. Impact on COGS/TOS. An increase in sales usually leads to higher COGS if the company sells products or higher COS if it provides services. This is due to increased production and labor activity to meet demand. Importance of managing spontaneous liabilities. Companies must carefully manage these automatic bills to ensure they have enough funds to meet these obligations comfortably. Significance for investors. Monitoring spontaneous liabilities is crucial for investors to understand a company's financial health, as rising liabilities can impact overall profitability, even if sales are increasing. Understanding spontaneous liabilities helps companies make better financial decisions and allows investors to assess a company's financial stability and performance more accurately. It ensures that companies can handle their day-to-day financial obligations smoothly and remain financially viable in the long run. Financial forecasting helps companies predict their future financial needs based on their expected growth. There are different ways to measure growth. One is the internal growth rate, which calculates the maximum growth a company can achieve without getting external financing. This growth comes from reinvesting the company's earnings back into its operations. However, growth isn't always straightforward, as it can put a strain on a company's management and operations. That's why there's another measure called the sustainable growth rate. Sustainable growth considers the company's financial policies, like debt-to-equity ratio, dividend payout ratio, profit margin, and more. It shows the annual percentage increase in sales that the company can handle while maintaining its financial goals. Beyond sustainable growth, there's something called the optimal growth rate. This measure looks at growth from the perspective of creating value for shareholders and overall profitability. It takes into account factors like return on assets, return on sales, and return on equity. The study shows that as revenue growth increases, profitability also rises up to a certain point. But beyond that, further growth may become less profitable due to the challenges it brings. In summary, financial forecasting helps companies plan for their future financial needs based on their expected growth. They can use measures like internal growth rate, sustainable growth rate, and optimal growth rate to understand how much growth is feasible and beneficial for the company's financial health and success. Simple explanation. Financial forecasting helps companies predict their future financial needs based on their expected growth. There are different ways to measure growth. One is the internal growth rate, which calculates the maximum growth a company can achieve without getting external financing. This growth comes from reinvesting the company's earnings back into its operations. 2. Mental models and analogies. A. The growing tree analogy. Imagine a tree that grows taller every year. The tree's height represents the company's growth. The tree can grow internally by using its own resources, like sunlight, water, and nutrients from the soil, without needing help from outside sources. This internal growth rate shows how much the tree can grow naturally on its own. B. The savings account analogy. Think of a company's retained earnings, profits it keeps after expenses, as a savings account. When a company reinvests those earnings back into the business, it's like putting money back into the savings account to grow it further. The sustainable growth rate is like the maximum amount the company can spend from the savings account each year while maintaining its financial policies. 3. Example exercises. A. Calculate the internal growth rate of company XYZ. Net income, $500,000 total assets, $2 million earnings retention rate. 60% answer. Internal growth rate equals net income / total assets. X earnings retention rate internal growth rate equals $500,000 / $2 million. X 0.60 equals 0.15 or 15%. B. Find the sustainable growth rate of company ABC. Net income, $800,000 shareholder equity, $5 million earnings retention rate, 40% answer. Sustainable growth rate equals net income / shareholder equity. X earnings retention rate sustainable growth rate equals $800,000 / $5 million. X 0.40 equals 0.064 or 6.4%. Advantages and importance. Advantages. Understanding the internal and sustainable growth rates helps a company plan for its future expansion without relying too much on external financing, which can be costly. It allows a company to set realistic growth targets and make informed financial decisions. Disadvantages. Growth beyond the sustainable rate may lead to challenges in managing operations and maintaining profitability. Overambitious growth goals without proper financial policies can strain the company's resources and lead to financial instability. Importance. Knowing the sustainable growth rate helps a company avoid overextending itself and ensures a stable and sustainable growth trajectory. Financial forecasting and growth rate calculations are crucial for investors, shareholders, and financial managers to assess the company's financial health and potential for future success. 12 key points to know in depth about financial forecasting, sustainable growth, and internal growth financial forecasting. It helps organizations predict their future financial needs based on expected growth. Internal growth. This is the maximum growth a firm can achieve without external financing. It comes from reinvesting its earnings back into the company. Sustainable growth. It's the annual increase in sales that aligns with a defined financial policy, ensuring growth stays in line with the company's goals. Optimal growth rate. This measure assesses sustainable growth from a shareholder return and profitability perspective, independent of specific financial strategies. Retention. It refers to the act of retaining or keeping earnings within the company rather than distributing them as dividends. Retention ratio. It's the proportion of retained earnings compared to net income. Sustainable growth rate, SGR. Formula. SGR equals ROE, 1 bit, where ROE is the return on equity and B is the dividend payout ratio. DuPont formula. This formula breaks down ROE into its 3 components: net profit margin, asset turnover, and leverage multiplier. Internal growth rate formula. It's calculated as retained earnings / total assets, multiplied by the rate of earnings retention. Sustainable growth rate formula. It's calculated as net income / shareholder equity, multiplied by the rate of earnings retention. Importance of financial policy. Sustainable growth is achieved by aligning growth plans with financial policies, like debt-to-equity ratio and profit margin. Optimal growth and profitability. Revenue growth tends to increase profitability up to a certain point, but beyond that, Additional growth may reduce overall profitability due to the challenges it brings. Understanding these key points will help you grasp the concepts of financial forecasting, sustainable growth, and internal growth, as well as their implications for a company's financial health and success. The sustainable growth rate, SGR, is like the maximum speed a company can grow without borrowing money from others. It's the rate at which the company can expand using its own profits without taking on additional debt. Achieving the SGR is important because it helps a company avoid financial troubles caused by too much borrowing. To calculate the SGR, you first find the company's profitability using a measure called return on equity, ROE. Then you subtract the percentage of earnings paid as dividends from one and multiply the result by the ROE. This gives you the SGR. Companies with high SGRs are good at maximizing sales, focusing on high-profit products, and managing their finances well. However, sustaining a high growth rate for a long time can be challenging, as it may require the company to invest in new products or face competition that affects profitability. A company's ability to manage its bills and receive payments on time is essential for maintaining a healthy SGR. If a company's growth exceeds its SGR, it might need to find ways to raise money, like issuing new shares or taking on more debt. The SGR is used by businesses to plan their long-term growth, make financial decisions, and assess their ability to repay loans. However, achieving the SGR isn't always easy, as economic conditions and consumer trends can affect a company's growth. Overall, the SGR is an essential metric for companies to know how fast they can grow without needing outside financing. It helps them make smart decisions about their expansion and financial health. Think of the sustainable growth rate, SGR, as the maximum speed a company can grow without needing to borrow money. It's like a company's own natural limit for how fast it can expand using its profits without taking loans. Achieving the SGR helps companies avoid financial troubles caused by too much borrowing. Analogies. A. Imagine a company is like a car, and growth is its speed. The SGR is like the maximum speed the car can go without running out of fuel or needing a tow truck, external financing. To maintain a steady and safe pace, the company needs to manage its expenses and use its profits wisely. B. Think of a company's growth as a plant growing in a pot. The SGR is like the rate at which the plant can grow while getting all the nutrients from the soil, its internal revenue. If the plant grows too fast, it might need a bigger pot, external financing, to sustain itself. Practice questions. A. How do you calculate the sustainable growth rate, SGR? Answer. You calculate the SGR by multiplying the company's return on equity, ROE, by the retention rate, 1 dividend payout ratio. SGR equals ROE asterisk, 1 dividend payout ratio. B. Why is achieving the SGR important for a company? Answer. Achieving the SGR is crucial because it helps a company avoid taking on too much debt and maintain a healthy financial position. It allows the company to grow at a steady and sustainable pace using its internal resources. Advantages and disadvantages. Advantages. Helps companies plan for long-term growth and make smart financial decisions. Allows companies to gauge their ability to repay loans and avoid financial distress. Encourages efficient use of internal resources to sustain growth without relying heavily on external financing. Disadvantages. Sustaining a high SGR in the long term can be challenging due to competition, changing economic conditions, and the need for research and development. Companies may face limitations if their growth outpaces their internal resources, requiring them to seek external funding. Achieving the SGR might be affected by consumer trends, economic conditions, and forecasting accuracy, which are not always within a company's control. Why is it important to know? Knowing the SGR is important for companies because it helps them understand their growth potential and make informed decisions about their financial strategies. It allows them to assess if they can fund their growth using their own profits or if they need to seek external sources of financing. Being aware of the SGR helps companies avoid excessive borrowing and maintain a healthy financial position for sustainable and successful growth in the long term. 12 key points to understand in depth about the sustainable growth rate, SGR. Definition. The sustainable growth rate, SGR, is the maximum rate of growth that a company can achieve using its own profits, without needing to borrow money or issue more shares. Purpose: the SGR helps companies determine their natural growth limit and avoid becoming over-leveraged or facing financial distress. Calculation: to calculate the SGR, multiply the company's return on equity, ROE, by the retention rate, 1 dividend payout ratio. Importance: knowing the SGR allows companies to plan for long-term growth, make informed financial decisions, and assess their ability to repay loans. Maximizing SGR: companies with high SGRs are effective in maximizing sales, focusing on high-margin products, and managing inventory, accounts payable, and accounts receivable. Challenges: sustaining a high SGR in the long term can be difficult due to competition, changes in economic conditions, and increased research and development. Managing operations: the SGR helps identify whether a company is managing day-to-day operations properly, including paying bills on time and collecting accounts receivable promptly. Inventory management: proper inventory management is essential to match and sustain the company's sales level without cash flow shortages. Accounts receivable: efficiently collecting accounts receivable is critical to maintaining cash flow and profit margins, avoiding the need for additional debt or equity. Stagnation risk: companies that fail to achieve their SGR are at risk of stagnation. While exceeding the SGR may require external financing to sustain rapid growth. Financial strategy: to raise capital for rapid growth, companies can issue equity, increase financial leverage through debt, reduce dividends, or improve revenue efficiency. Limitations: external factors like consumer trends and economic conditions can impact a company's ability to achieve its SGR. Companies must also compare their SGR with industry peers for meaningful benchmarks. Understanding the SGR is essential for companies to plan their growth. Strategies wisely, avoid financial risks, and ensure sustainable long-term success. Imagine you have a business, and you want to make it bigger by increasing sales. To do that, you'll need more money to buy new things like equipment, inventory, and maybe hire more people. This extra money you need is called Additional Funds Needed, or AFN. AFN helps you calculate how much money you'll need to raise to make your business grow. You can use a formula that considers things like your current sales, the expected increase in sales, and the money you keep from your profits. If the result is positive, it means you'll need to find external funding, like loans, to cover the expenses. If it's negative, hooray! Your project will make extra money that you can invest in other things. AFN helps you plan wisely, so you know if your business can handle the growth without running out of money. It's like using a math formula to figure out how much money your dream project will cost and whether it will make enough profit to be a success. In short, AFN is a way to figure out how much money a business needs to expand, and it helps them plan and find the right funding to make their growth successful. AFN, Additional Funds Needed, is like calculating how much extra money a company needs to grow. It helps businesses figure out if they can afford to expand without borrowing money. If the result is positive, they need to find external funding. But if it's negative, hooray! They'll have extra money to invest. Mental model: business growth budget. Imagine a company as a person planning a big party. To make the party bigger, increase sales, they need more snacks, drinks, and decorations, assets. But they also need to pay for it all, liabilities. AFN is like their budget plan. It calculates if they have enough money from their savings, retained earnings, and if they need to ask friends for help, external funding, to throw the awesome party they want. Example exercise. Let's say Company X wants to increase sales next year by $100,000. They expect their profit margin to be 20%, and their retention ratio, money they keep from profits, is 80%. If their current assets tied to sales are $50,000 and spontaneous liabilities are $20,000, calculate their AFN. Exercise answer: AFN equals assets * change in sales, liabilities * change in sales, projected net income * retention ratio. AFN equals $50,000 * $100,000, $20,000 * $100,000, $100,000 asterisk 0.80, AFN equals $5 million, $2 million. $80,000 AFN equals $2,920,000. The company needs an additional $2,920,000 in funding. Advantages and disadvantages and importance. Advantages. AFN helps companies plan their growth wisely, avoiding financial troubles. It guides them in seeking the right funding sources. By knowing how much money they need, they can be prepared and make better decisions for expansion. Disadvantages. The calculations can be complex and depend on various assumptions. External factors like changing markets may affect the accuracy of AFN. If not used carefully, it might lead to wrong financial planning. Importance. AFN is essential because it shows if a business can grow without running out of money. It helps them decide how to finance their growth, ensuring they can achieve their goals and avoid potential financial risks. 12 key points to understand the topic of additional funds needed, AFN, or discretionary financing needed, DFN, AFN definition. AFN stands for Additional Funds Needed, which refers to the extra money a company needs to expand its operations or achieve higher sales. Purpose of AFN. AFN helps businesses calculate how much new funding they require to support their growth plans. Reducing reliance on external funding. AFN allows companies to explore ways to reduce their dependence on borrowing money from outside sources for growth. Simple AFN formula. The basic formula for AFN is AFN equals projected increase in assets, spontaneous increase in liabilities, any increase in retained earnings. Positive versus negative AFN. If AFN is positive, it means the company needs external funding to achieve its goals. If AFN is negative, it indicates the company will generate extra income to invest without borrowing. Determining AFN. AFN calculations are based on how liabilities will change concerning new assets and sales when a project is undertaken. Key terms. In AFN calculations, assets represent valuable resources, sales refer to revenues, and liabilities are future. Payments the company owes. AFN and business expansion. AFN is particularly relevant when a company plans to expand its operations or influence in the market. Financial statements input. AFN calculations use data from a company's financial statements, like sales forecasts and retained earnings. Formal AFN equation. The more formal AFN equation includes various factors like the change in sales, profit margin, and the retention ratio. Impact on financing decisions. AFN helps companies make informed decisions about how to finance their growth, whether through internal funds or external sources. Mathematical tool. AFN serves as a mathematical tool to assess the feasibility of a project or operational expansion for a business. Remember, AFN is crucial for businesses to plan their growth wisely and ensure they have enough funds to achieve their objectives without over-reliance on external financing. Imagine you have a business and you want it to grow and make more money. To do that, you might need extra money to buy things like new equipment or hire more people. That extra money you need is called Additional Funds Needed, or AFN. AFN helps you figure out how much money you'll need to make your business grow. You calculate it by looking at how much your assets, like equipment and inventory, will increase, how much your liabilities, like debts and taxes, will go up, and if your profits from last year will also change. If the result is a positive number, it means you'll need to find some external funding, like getting a loan from a bank, to make your plans work. But if the result is negative, that's great news. It means your business will actually make extra money, and you can use it to invest in other things. Knowing AFN is important because it helps you plan how to fund your business growth wisely. You can figure out if you need to borrow money or if your business can generate enough money on its own. So it's like a financial roadmap to make sure your business stays on track and keeps growing. AFN, Additional Funds Needed, is like a financial puzzle that helps businesses plan for the future. It calculates how much money a company will need to grow and expand. If the result is positive, it means the company needs more money from external sources, like loans, to make its plans work. But if the result is negative, it's good news. It means the company will make extra money and can use it for other things. Mental model. The expansion plan. Imagine you have a lemonade stand and you want to sell more lemonade. To do that, you'll need more lemons, assets, and maybe some extra cups, liabilities. AFN is like a recipe that tells you how many lemons and cups you need to make and sell more lemonade. If the recipe says you need to buy more lemons than you have, you'll need help from your parents, external funding, to get those lemons. Practice exercise. Let's do a quick example. Last year, your lemonade stand made $500 sales, and this year, you expect to make $800 projected sales. Your costs for lemons and cups are $100, spontaneous liabilities, and you plan to keep $50 as profit, retained earnings. Calculate AFN to see if you need external funding. AFN equals projected sales, spontaneous liabilities. Retained earnings AFN equals $800, $100. $50 AFN equals $650, the result is positive, which means you'll need $650 from your parents or someone else to buy more lemons and cups for your lemonade stand's expansion. Importance. Knowing AFN is crucial for businesses because it helps them plan wisely. If a business needs external funding, it should be prepared to manage it responsibly. On the other hand, if a business can generate extra money, it can use it to grow without borrowing. By understanding AFN, a company can make better financial decisions and avoid getting into unnecessary debt. By using these mental models and practicing with simple examples, you can grasp the concept of AFN better and see how it's essential for business planning. 12 key points about capacity planning and utilization capacity planning. This is a process where a company figures out how much it can produce to meet the demand for its products. Capacity utilization. It shows how much of the company's production capacity is actually being used to make things. Design capacity. This is the maximum amount a company can produce in a given time, assuming everything goes perfectly. Effective capacity. It considers real-world constraints like delays or quality, issues that affect how much the company can produce. Adjusting capacity. This means changing the production level to match the company's long-term goals and sales forecasts. Why adjust capacity? It helps prevent the company from growing too fast and ensures efficient use of resources like capital. Capitalism. This is an economic system where private individuals or businesses own resources and make decisions in a free market. Excess capacity. Sometimes, industries have more production capacity than they are using, which might not be as efficient. Capacity utilization rate. It tells us how well the resources are being used to make products. Forecasting success. Capacity utilization helps predict a company's future success and financial performance. Efficiency indicator. It shows how well a company is using its resources to produce goods. Decision making. By adjusting capacity, company leaders can decide how to grow the company in the best way they think. Importance. Capacity planning and utilization are crucial for companies to ensure they can meet customer demands, use resources wisely, and grow in a controlled and efficient manner. By analyzing and adjusting their capacity, businesses can make better decisions about their future growth and success. Discretionary financing need. DFN is a concept that helps a company figure out how much external funding, like loans or investments, it needs to grow. To reduce the reliance on external funding, there are a few methods a company can consider. Slow down sales growth. By raising the prices of its products, the company can slow down the rate at which it's growing. This has two benefits. First, higher prices mean more profit for the company, so they can keep more money without needing to borrow. Second, slower growth means they won't need as much money to expand their business. Reevaluate capacity. The company needs to check if it really requires as much investment in fixed assets, like equipment and buildings, as it initially thought. Maybe they can manage with their current resources or outsource some production needs instead of spending more money on fixed assets. Reduce dividend payments. If the company is paying a lot of money as dividends to its investors, it can consider lowering the dividend payments. This way, they keep more of their earnings within the company and won't need as much external funding. Improve net margin. Net margin is the money a company makes per dollar of sales. By increasing the net margin, they can retain more cash within the company, which reduces the need for external funding. They can achieve this by either increasing the product prices or cutting costs, for example, by getting better deals from suppliers or managing expenses more efficiently. It's essential for the company to carefully plan and understand how these changes in their financial decisions affect everything else. Financial planning is more than just predicting future numbers. It involves considering how different aspects of a company's finances are connected and how changing one thing can impact others. By wisely managing these factors, a company can reduce its dependence on external funding and achieve better financial stability and growth. Imagine a money bucket. Think of a firm's finances as a bucket that holds all its money. The money in the bucket can be used to buy assets, like equipment and buildings, or to pay off debts and dividends. The difference between the money used for assets and the money paid off is the discretionary financing need, DFN. To reduce the DFN, we want to find ways to keep more money in the bucket, so the firm doesn't have to borrow or get external funding. DFN reduction tools. Just like a toolbox with different tools, there are 4 methods to reduce DFN. A slowing sales growth. Imagine a fast car, the company's growth, going too fast and consuming a lot of fuel money. By slowing down the car, reducing sales growth a bit, it will use less fuel, cash, and you can keep more of it in the bucket. B. Capacity constraints. Picture a factory with machines. If the factory is already running at its maximum capacity, you don't need to buy more machines, fixed assets, right away. You can work within the existing capacity to save money. C. Lower dividend payout. Imagine you and your friends share a pizza. The earnings. If you keep more slices, earnings, for yourself and share fewer with your friends, dividends, you can save more money. D. Increased net margin. Think of net margin as a percentage of profit for every dollar you earn. If you find ways to earn more profit without increasing costs, you get to keep more money in the bucket. Practice exercise. Let's try a quick exercise. Based on the example provided, calculate the current DFN for the firm and find ways to reduce it using the 4 methods. Example data. Current assets. $24 million future assets. $30 million total liability. $17 million total equity. $10 million DFN calculation. DFN equals future assets, total liability. Total equity DFN equals $30 million, $17 million. $10 million DFN equals $3 million. Ways to reduce DFN. Slowing sales growth. Increase product prices to reduce sales growth and keep more money in the firm. Capacity constraints. Check if the firm can work with current resources instead of investing in more fixed assets. Lower dividend payout. Reduce the dividend payments to retain more earnings within the firm. Increase net margin. Find ways to increase profit without increasing costs. Advantages and importance. Reducing the firm's DFN is crucial for several reasons. Advantages. Less dependence on borrowing. By reducing the need for external funding, the firm can avoid taking on more debt and the associated interest expenses. Financial stability. Keeping more money within the firm provides a safety net during challenging times or unexpected expenses. Improved profitability. Increasing net margin and efficiently managing finances can lead to higher profits and better overall performance. Importance. Long-term growth. A firm with reduced DFN can invest more in profitable opportunities and expand steadily. Shareholder confidence. Shareholders and investors prefer companies with sound financial planning and lower reliance on external funding. Risk management. Understanding the firm's financial interactions helps identify potential risks and make better informed decisions. Remember, the key is to strike a balance between financial growth and stability while keeping the money bucket full. 12 key points to understand the topic of reducing a firm's discretionary financing need. DFN. Discretionary financing need, DFN. DFN is the difference between a firm's total assets and its total liabilities and owner's equity. It represents the extra funding the company needs to grow. Goal of reducing DFN. The objective is to find ways to reduce the firm's reliance on external funding, like loans or investments. so it can be more financially stable. Methods to reduce DFN. There are 4 main methods to achieve this. Slowing sales growth, reevaluating capacity constraints, lowering dividend payout, increasing net margin, slowing sales growth. By raising product prices, the firm can slow down sales growth. This increases net margin and reduces the need for external financing. Capacity constraints. The company should check if it really needs to invest heavily in fixed assets. It might be able to work with existing resources or consider outsourcing to save money. Lower dividend payout. Retaining more earnings within the firm by reducing dividend payments can help decrease the DFN. However, shareholders may not always like this decision. Increase net margin. Improving the firm's net margin, profit per dollar of sales, will allow more cash to be retained within the company, reducing the need for external funding. Financial planning complexity. Financial planning involves understanding how different variables in the firm's finances interact with each other. Changing one aspect can impact others. Example scenario: consider a firm that expects a high growth rate, which requires an additional $3 million in external funding. $30 million, $17 million, $10 million. Long-term growth. Reducing DFN is crucial for the firm's long-term growth and stability. Investor confidence. Shareholders and investors prefer companies with sound financial planning and lower reliance on external funding. Risk management. Understanding the financial interactions helps identify potential risks and make better informed decisions. By grasping these key points, you'll have a better understanding of how a company can manage its finances more effectively and reduce its dependence on